in grade 12 economics. We are in chapter 6, the open economy, macroeconomics. So already we have discussed about what does it mean. Okay, the term open economy, what does it mean? So far we were discussing about a closed economy where we were discussing only about our country. We were discussing about how we transact with the other countries and what is the impact of it. So in the last session we have discussed about what do we mean by an open economy, what is foreign trade, what are the various linkages that we have. So basically open economy is where we interact, we transact with other countries through various channels. It's called an open economy. And what are the various linkages we have with the under the topic open economy? We have the product market, the output market, we have the financial market, and then we have the labor market. So the output market is seen as a substitute for the labor market, so hence we started discussing only about the output market and the financial market, right children? And then what is actually output market? The trade of goods and services between two countries is called as the output market. What is meant by financial market? The financial assets, buying and selling of financial assets between two countries are called as financial market. And then the labor market is when the factors of production are taken into a different country for it. So workers choose where to work. Okay, so we saw that the movement of goods is a substitute for the movement of labor. So we actually started discussing about output market and financial market in detail. And what is foreign trade and how does it influence the Indian aggregate demand is what. So foreign trade means buying and selling of goods. So when we are importing, when consumers go for products that are made in other country, the aggregate demand comes down because they are not procuring the domestic goods, they are consuming the foreign goods. Okay, so there the aggregate demand comes out and it's called a leakage. So the other aspect is called the injection, where the foreigners, they consume the products that are made in our domestic economy. So that is called as what? It is called as injection, where there is a circular flow where it increases the aggregate demand that for the product that is produced in the domestic economy. And we saw that in foreign trade, when goods and services move across various nations, various countries, money acts as again a common medium for transaction. Just like how even inside our country we discuss that money acts as a common medium for transaction. Similarly, for any transaction, money plays as a common medium. But here what is the problem is that every country will have a different national currency. Right? They don't have the same national currency. So we have to have a common international currency that is accepted everywhere. But is that possible? No, it is actually not possible. So they go for a thing called foreign exchange. Okay? Money has an equal purchasing power in every country, but the value of money of my country will differ from the value of money that is used in another country. So the currency that is the value of or the price of one currency in relation with another currency is called the currency of another country is called as the foreign exchange rate or the exchange rate. So how is it dealt with? It is dealt basically in the beginning it was exchange. Any currency can be exchanged into gold or into other countries is what we have discussed. Okay, but now we have just stuck with what? We have just stuck with exchanging into another national currency. Why is it not being changed into gold? Why has it been stopped? It is a related topic which we will be discussing at the end of the chapter. We are not going to discuss it right now. We are going to go into the other things. We are going to discuss why that particular thing, that is why gold has ceased to exist as a exchange thing. You cannot use it as an exchange for your currency anymore, is what we be discussing later towards the end of the chapter, because I don't want you to get confused with the topic that we are going to discuss right now. We're going to talk about the balance of payments. Okay, what did we discuss? We said that balance of payments, just like in the budget we have a capital budget and a revenue budget. This balance of payments is a record. Okay, what is balance of payments? Balance of payments is marked as B small p. Okay, what does it mean? It is the record for transactions of goods and services at an international level. Okay, so what is it? The balance of payments record the transactions in goods, services and assets between residents of a country with the rest of the world. Okay, for a specified time period, usually a year. So records for transactions in goods, services, assets, okay, for a particular financial year. Between whom? Between the resident of a country and the rest of the world. And the rest of the world. Being the resident of India, when I have a transaction in terms of goods, services or assets with the other country, any country, then that is recorded in a thing called balance of payments. Okay, it is usually done for one financial year. So when does a financial year start, children? April 1st of every year it starts and it goes on till the March 31st of the next year. Alright, that is called a financial year, and there are two main accounts in a BOP, that is the current account and the capital account. So what are the two main accounts of a BOP? That is a balance of payments. We have the current account and we have the capital account. Now what is a current account? It is a record of trade in goods and services and transfer of payments. So we are going to discuss it with a picture, with a table, a flow chart about the components of current account. Just how we discussed about budget and its components, we are going to have the current account and its components. So what are the three basic things? Trade in goods, trade in services and transfer payments. So we have trade in goods, and we have trade in services and transfer payments. Right. So these are the main components of a current account. What are the three things that are recorded in a current account, children? We record the trade in goods, services and transfer payments. What are the various things under this trade in goods, trade in services and transfer payments is what we are going to have. Trade in goods, we have two things: exports and imports. What are the two things, children? Exports, goods and services means first goods when we say exports and imports. Exports means from our country, when we give it to another country, then it is exports, and we have already discussed that it will increase the aggregate demand. Right? Import, when you buy goods from the rest of the world, from anywhere other than your country, it is called import, and it decreases the aggregate demand of your country in a particular product. Okay, basically exports are considered as revenues, okay, whereas imports are considered as expenditures. Right, children? So what is it? It's just buying goods from foreign is an expenditure, it's an import. Okay, so you're buying it, it's an expense already. And what does it also do? It becomes the income of the foreign country. That is, whatever you pay for buying product, it goes to the income of the other country, and the aggregate demand also falls. So the purchase of foreign goods or imports decreases the demand, domestic demand for goods and services in our country. So similarly, selling goods to foreign countries, that is increasing, that is the exports will increase the aggregate demand, and it is a revenue, it is an income for our country. What we produce here, we selling it to another country, then it is a revenue for our country. What else? We have trade and services, net factor income and net non-factor income. So we have net factor income, net non-factor income. What are the various things that come under net factor income and net non-factor income? Net income from compensation of employees. People who work in different countries, they get salaries. Okay, that is termed to be a net factor income. What is it? Trade and services includes factor income and net non-factor income. Transfer payments are the rest. So talking about first this, it includes what? Compensation of employees who work in other country, and then net investment income. When some other countries, they invest in our products, in our goods and services, then that is net investment income. Okay, so service, you're working there as a service. It's not a good to be sold. You're a worker and you're serving there. It's a service. It's considered to be trade and services. And then compensation that an employee receives from other country, it's termed to be net factor income. And one more thing is that net investment income, where the other countries, they decide to invest in our country. So definitely when they invest in our country, the factors of production used in our country will be getting paid. Right, that is what we are discussing. Net non-factor income means anything and everything that is not related to the factors of production, like shipping, transportation, banking, insurance, tourism and development, everything comes there. So what are the various things? Shipping, insurance, transportation, tourism, and so on. Okay, when foreigners come to our country, they visit our country, they spend some amount in our country, they pay the guides and all those are called net non-factor income, insurance, shipping. Okay, all this comes under what? Net non-factor income. What is the transfer payments? Already we have discussed transfer payments. Is that something given by the government to us? Okay, some subsidies, some gift coupons like that. So here we have gifts, remittance and grants. When other countries they are giving to us, they consist of gifts. So transfer payments, all the receipts which the residents of a country we get for free without having to provide any goods or services in return. They consist of gifts, remittances and grants. So they are what? Gifts, remittances okay, from a different country, okay, from a different company's website. You just go for buying and they give you a 10% discount. That's a transfer payment, okay. Or when you win a cashback offer from a foreign website or something, that's a transfer payment. Okay, children. So what are the components of the current account? We have trade, any transaction related with trade in goods, services and transfer of payments are recorded in what? In the current account. So what are the various things? We have goods, services and payments. Under goods we have exports and imports. Exports are considered to be revenue because foreign people buy our goods. Okay, so it increases the aggregate demand of a product, domestic economy. Whereas in imports, if you talk about imports, you buy goods from other country. This decreases the aggregate demand for the domestic economy as well as it is considered to be expenses because you are going to pay and get, and that will become the income of another country, not your country. And then trade and services, we have two: net factor income and net non-factor income. Net factor income, something that is paid for the factors of production. So compensation, the employees receiving salary from foreign companies. A net investment income comes under the net factor income, and then non-factor income will be shipping, insurance, tourism and all those things, banking, okay, software services and all those things. And then finally transfer payments. So when you get something for free from other countries, that is called to be as what? Transfer payments. So you get gifts, remittances and grants from other countries. What are the examples for transfer payments in our country, in domestic economy? Subsidies. Alright. So same way interest. Okay. And when the government is paying you something, giving free of cost of something, then those now come under the transfer of payments. Now how do you adjust the balance on current account? Just like the expenditures and revenues, here also we have expenditures and revenues, right? So how do you adjust it? Current account is in balance when receipts on current account are equal to the payments in current account. So here you have the receipts and you have the payments also. Where do you have payments? You have payments in imports, right? You have payments in imports, right? Same way, when you are involving shipping to other country, then that will be what? An expenditure, right? So when you are getting it, it's an income, payment, receipt. When you are paying it, it's a payment. So how do you find the balance? When is it in surplus? When is it in deficit? And when it is in balanced, is what we are going to discuss. It's very simple to discuss actually. Okay, so the capital account is said to be in surplus. Okay, capital account surplus is when the receipts are more than the payments that we have to make to the other countries. Okay, that is capital accounts surplus. Talking about, sorry, not capital account, children, current account. I'm very sorry. Talking about current account, you know. Okay, and then current accounts balanced one. When do we have a balanced thing? So when the receipts are equal to payments, we call it balanced. Finally, current account deficit. Here also we might have what? A deficit situation where receipts are lesser than payments. Then this is called as current account deficit. So what are the three conditions? We have a surplus, balanced or deficit. So if the receipts are more than the payments, then it is surplus. If the receipts are equal to the payments, it is balance. If the receipts are lesser than the payments, it is a deficit condition. So in a deficit current account, the nation is a borrower from other countries. That is, we need to pay more than what we have received means we are owing them some money. So we have borrowed something is what is understood. And when it is more surplus current account, it means that we lend. Okay. So some other countries, they owe us. They have to pay money to us. So it means that we have lent to them. Our country has lent to them. Right? So in case, in this condition where surplus is there, our country becomes a lender. In deficit condition, it becomes a borrower. Right? That is one. And balance on current account has two important components. So this was about balance of payments. Under balance of payments, we had two components, namely current account and capital account. Under balance on current account, okay, under balance on current account, we again have two components, namely balance of trade or trade balance and balance on invisibles is what we are going to discuss now. And what is this? Balance on current account. So what are we going to discuss now? We are going to discuss about the balance on current account. What are the components of balance on current account? So let us discuss it in the same way. So it will be easy for us to understand. What are the two things, children? Balance of trade and balance on investments. So this is balance on current account. What are the two components? We have the balance on trade or trade balance. One is called what? The balance on trade or trade balance. Okay, and then we have balance on investments. Right. What are they? Balance of trade, that is BOT. Or what? Means the difference between the value of exports and value of imports of a goods of a country in a given period of time. So export of goods is entered as credit item in BOT, and whereas import of good is entered as debit item in BOT, it is also known as trade balance. So it is the difference between exports and imports. Okay, the difference between what? Exports and imports. Right, children? And what else? What is given as the credit item here? Exports is given as credit item and imports is given as the debit or the debt, because we owe them. Right? We need to pay. When we are getting imports, we are the borrower, and exports, we are the what? Lender. We are giving them. Right. So that is what we have done here. So whenever we mention exports in the balance of trade, it is mentioned in terms of credit, and imports are mentioned as debit. And what is it also called? It is called the trade balance. Sometimes it will be in minus, sometimes it will be in plus. If the exports are more than imports, then it will be in plus. If If the imports are more than the export, it will be in minus. Okay? BOT is said to be in balance when export of goods are equal to the import of goods. When you have them equal, then it is called what? Balance. Surplus BOT or trade surplus will arise if country exports more goods. When the country exports more goods, it is surplus. When the country imports goods more than its exports, then it is called deficit. When it is in balance, when both are equal. So, what are the conditions here? So, we have surplus. When do we have surplus, children? Exports is equal to imports. Okay? When do we have, exports more than imports? When do we have a balanced one? When we have exports is equal to imports. When do we have deficit? When we have exports lesser than imports. When we import more and we export less, then it is said to be in deficit. Okay. Net invisibles. Balance on invisibles. Net invisibles is the difference between the value of exports and value of imports of invisibles of a country in a given period of time. So here also exports and imports, but here it was entirely about goods. Okay, here what is this? It's entirely about goods. Invisibles means what? We have services, transfer of payments, flow of foreign exchange. Okay, so when here the balance, right, the difference between the value of exports and the value of imports of what? Services, transfer payments and flow of income is considered to be the net balance of invisibles. Okay, services trade includes both factor and non-factor income. Factor income what? Net international earnings on factors of production, and non-factor income is net sale of services, products like shipping, banking, tools and so on. Already we have discussed this in components of current account, isn't it children? We have discussed it in trade and services. We have discussed what are the various components. We have net factor income, net non-factor income. So this trade and services will come under what? Will come under the balance on invisibles. Okay, the second two columns. First one, trade and goods, comes under the topic the balance on trade, whereas the second two topics, the last two topics, trade and services and transfer payments, come under balance on invisibles. Okay, the difference between the value of exports and imports on invisibles is called as balance on invisibles, whereas the difference between the exports and imports of goods is called as balance of trade. Okay, or trade balance. Understood children? So what is entirely about current account? It is the record of trades in goods and services, trade in goods, services and transfer payments in a particular financial year is called as current account. And what are the various components of it? We have trade in goods, trade in services and trade in transfer payments. So trade in goods comes under the value of exports and imports are talked about it, the balance on trade statement, whereas the balance on invisibles is where we discuss about the trade in services and transfer payments. Alright, what are we going to discuss now? We are going to talk about capital account. We said that we have two accounts to discuss under the topic balance of payments. So we are going to discuss about the capital account, right? Current account is what? It's a record of transactions, services, goods and transfer payments. Now what is going to be the capital accounts? Can you guess? Being account students, What are the things that we have in capital? The assets, okay, the long-term investments, that and all will come under this capital account, and we are going to explain it through the components of capital account. What are we going to do? We're going to talk about the components of capital account. It records all international transaction of assets. There it was goods, services, transfer payments. Here it is about the assets. So an asset is any one of the forms in which wealth can be held. It can be a machinery, it can be money, it can be stocks, debts, shares, okay, anything. Purchasing of asset is a debit item on the capital account, and sale of assets is a credit item. Exports is equal to sale of asset. Imports is equal to purchase of asset. That is how we are going to understand these things. So what are the various components of capital account? Okay. It has three components: investments, external borrowings, external assistance. So we have investments, wealth in form of anything, okay? Investments, external borrowings, and external assistance, right? What are the various things we are going to have under the topic of investments? We have two: direct investment and portfolio investment. What is the direct investment? So when they invest in FDI, equity capital, okay, reinvested earnings and other direct capital flows, and they are called as direct investment. So foreign direct investment, you remember we discussed under the new industrial policy 1991 in business studies, right? The foreign direct investments or foreign institutional investments, okay, those are examples of what? Direct investments. Investments in FDI, FII, not FII. FII is going to be in portfolio. So these items of foreign direct investments, okay. So what are the direct investment? Foreign direct investment. And what is the portfolio investment? Offshore funds. Foreign institutional investments through some institutions, through some organizations when they invest, that is called a portfolio investment. Directly into the country's economy they invest, whereas portfolio they come through another source. Okay children, so that is what is. Next is external borrowings. What is external borrowings? External commercial borrowings or short-term debt. When you borrow something from other countries, okay? Commercial borrowings, and short-term debt. Okay, and then finally external assistance. See, borrowing is different from assistance. Borrowing we need to repay. Assistance is like a financial help that is given to us from another country. So when we have a flood here, when we have a natural calamity here, when we have some diseases or something like that, the government, the other countries' government, they give us some aid, some help. Government aid, intergovernmental, multilateral and bilateral loans. When they, take it together and they want to share it and they pay it. Sharing of the burden, that and all comes under external assistance. So something that is coming from out is called an external assistance. So borrowing is different from assistance. Borrowing, you need to repay it, whereas assistance is just kind of a help. What does it mean by assisting? Helping. Alright. So what is it, children? What are the components of capital account? We have investment, external borrowings and external assistance. Investments, we have two. We have the direct investments and portfolio investments, external borrowings and external assistance. Meaning of direct investments: when they invest directly in funds like foreign direct investment, directly into the government, then it's direct investment. Portfolio, when they do through some institutions, some offshore funds, then it is called as portfolio investment. External borrowings, when we borrow from other countries in institutions like commercial borrowings and short-term debt. Whereas external assistance means the help that we get from the external sources out of our country, okay, government aids and all those things. So how do you find the balance on capital account? Just like we said, purchase of an asset and sale of an asset. Purchase of an asset is considered to be what? It's the debit item, and sale of an asset is considered to be a credit item. Capital account is in balance. When is it in balance? When capital inflows, okay, like receipt of loans from abroad, sale of assets or shares, that is equal to capital outflow. So when do you have a balance? Capital account inflows is equal to outflows. What are inflows? Loans, sale of asset. Through sale of asset you get income, and then there is inflow. Outflow, when you purchase asset, when you lend something, okay, that is called as capital outflow, repayment of loan and all those things. Surplus in capital account arises when what happens? The capital inflows are greater than outflows, and deficit happens when outflows are more than the inflows. Just like how we have discussed deficit, surplus and balanced budget, similarly only for current account and capital account it works. So when the inflows and outflows are equal, then it is said to be balanced. When the inflows are more than the outflows, then it is said to be in surplus. When the outflows are more than the inflows, then they are said to be in deficit. That is the balance on capital account. Right, children? So in balance of payment, how are we going to match this surplus and deficit situations is what we will be discussing in the next class, where we are going to have, the errors, omissions and all those things. What are the things that we have discussed, children? We spoke about what do we mean by balance of payments. So it is basically a record of transactions in which goods and services and assets for a particular financial year is being discussed. So the rest of the world for a specified period of time, that is a resident of one country, whatever transaction he does or she does with the rest of the country is termed to be in the balance of payments. It has two accounts, like the current account and the capital account. The components of current account were trade in goods, trade in services and transfer payments. Trade in goods was mentioned in balance of trade or trade balance, and trade in services and transfer payments were named in balance on invisibles, right? They were named as invisibles. Then we discussed about capital account, where we have three important components: the investments, external borrowings and external assistance. It is said to be, capital account is said to be in balance when the inflows are equal to outflows, and it is said to be in surplus when the inflows are greater than the outflows, and it is said to be in deficit when the outflows are greater than the inflows. Right? And how did it work for capital account, current account, children? When the receipts are equal to payments, it was a balance. When the receipts were more than the payments, it is supposed to be a surplus. When the receipts are lesser than the payments, it is supposed to be a deficit. Clear, children? I hope you have understood the topic. Please go through the topic, make sure you answer the worksheet correctly and draw the concept maps when and where required. Thank you and may all have a good day today.